Beyond Tesla stock, exploring the TSLY option strategy. Hey everyone, and welcome back to Chat ETF. Today, we're diving into the world of the TSLY ETF, also known as the YieldMax Tesla Option Income Strategy ETF. Ever wondered how you can earn consistent income while staying exposed to the exciting Tesla story? Well, the TSLY ETF might be the answer you've been searching for. But before you jump in, there's a lot to unpack. We'll explore how TSLY uses unique option strategies to generate income, weigh the pros and cons of adding it to your portfolio, and even compare it to alternative investment options. Hit that like button and subscribe for more in-depth ETF analysis. Alright, let's get started. Question 1. What is the TSLY ETF? TSLY, the YieldMax Tesla Option Income Strategy ETF, is an actively managed fund launched in October 2021 by Elevate Shares. It does not track a specific index, but instead focuses on generating income by employing option strategies on Tesla, TSLA, stock. Question 2. How does TSLY generate income? TSLY primarily utilizes covered calls and cash-secured puts to generate income. 1. Covered calls. TSLY sells call options on Tesla shares held by the fund. These options grant the buyer the right, but not the obligation, to purchase the underlying shares at a specific price, strike price, by a certain date, expiration date. In return for selling the call options, TSLY receives a premium upfront. If the Tesla stock price remains below the strike price by the expiration date, the call options expire worthless, and TSLY keeps the premium received. However, if the Tesla stock price rises above the strike price, the option holder may exercise their right to purchase the shares from the fund at the strike price, which could result in the fund selling its shares at a lower price than the current market value. 2. Cash-secured puts. TSLY sells put options on Tesla while holding cash equal to the strike price of the options. These put options obligate the fund to buy Tesla shares at the strike price if the option holder exercises their right to sell. By selling the put options, TSLY receives a premium upfront. If the Tesla stock price remains above the strike price by the expiration date, the put options expire worthless, and TSLY keeps the premium received. However, if the Tesla stock price falls below the strike price, the option holder can exercise their right to sell their shares to the fund at the strike price, potentially forcing the fund to acquire Tesla shares at a higher price than the current market value. Question 3. What are the potential benefits of investing in TSLY? TSLY. Potential benefits of investing in TSLY include 1. Income generation. By employing covered calls and cash-secured puts, TSLY aims to generate consistent income regardless of the direction of the Tesla stock price. This income can be attractive to investors seeking regular distributions. 2. Potential for capital appreciation. While the primary focus is on income generation, TSLY still holds Tesla shares. If the Tesla stock price appreciates, the fund benefits from capital appreciation alongside the income generated. 3. Reduced volatility. Option strategies can potentially help to reduce the overall volatility of the fund compared to holding Tesla shares directly. This can be attractive to investors seeking a less volatile investment option, while still maintaining exposure to TSLA. Question 4. What are the risks involved in investing in TSLY? TSLY. Investing in TSLY comes with inherent risks, including 1. Limited capital appreciation. TSLY primarily focuses on income generation. If the Tesla stock price significantly increases, the potential for capital appreciation within the fund might be limited, especially if the sold calls are exercised. 2. Downside risk. While covered calls and cash-secured puts can potentially help to hedge against some downside risk, they do not completely eliminate it. If the Tesla stock price falls significantly, the fund may be forced to sell shares at a lower price, or buy shares at a higher price than the current market value, depending on the option strategies employed. 3. Management fees. As an actively managed fund, TSLY charges management fees, which can reduce its overall returns compared to passively managed ETFs. 4. Complexity. Option strategies can be complex, and investors should fully understand the risks involved before investing in TSLY. Question 5. Who is TSLY suitable for? TSLY. TSLY may be suitable for investors seeking 1. Exposure to Tesla with reduced volatility. Investors interested in exposure to Tesla, but with potentially lower volatility compared to holding the stock directly. 2. Alternative income strategies. Investors seeking alternative income sources beyond traditional fixed income investments. 3. Technology enthusiasts. Individuals who believe in the transformative power of technology and want exposure to leading tech companies. 4. Long-term investors. Those seeking to capitalize on the growth potential of the technology sector over the long term. 5. Passive investors. Investors looking for a passive investment vehicle that offers diversification and tracks the performance of the technology sector. Question 6. What are some alternatives to TSLY? TSLY. Several alternative investment options can offer similar benefits or expose you to Tesla. 1. Tesla stock, TSLA. Owning Tesla shares directly offers the potential for capital appreciation if the stock price rises. However, it comes with greater volatility compared to TSLY. 2. Other option-based income strategies. Other ETFs or investment vehicles may employ different option strategies to generate income, potentially offering different risk and return profiles. 3. Broad market ETFs. Investing in broad market ETFs, like the SP 500 Index ETF (SPY), provides diversified exposure to a basket of companies, including Tesla, while offering lower volatility than holding Tesla directly. Question 7. How does TSLY's option strategy selection process work? TSLY. The specific options chosen by TSLY are actively managed by the fund's investment advisor. They consider factors like 1. Market volatility. Higher volatility may lead to selling options with shorter durations and lower strike prices to generate higher premiums, while lower volatility may favor longer durations and higher strike prices. 2. Tesla stock price and implied volatility. The option selection depends on the current Tesla price and implied volatility, aiming to maximize premium generation while managing potential downside risk. 3. Time to expiration. TSLY may use a combination of short-term and long-term options to balance income generation and risk management. Question 8. How does TSLY manage the rolling of expiring options? TSLY, as options approach their expiration date, the fund manager will decide whether to 1. Roll the options, close out the expiring options and sell new options with similar or different parameters, depending on market conditions. 2. Let the options expire. If the options are not profitable, or if market conditions are not favorable, they may be allowed to expire without replacement. Question 9. How does TSLY's option strategy selection process work? TSLY, the specific options chosen by TSLY are actively managed by the fund's investment advisor. They consider factors like 1. Market volatility. Higher volatility may lead to selling options with shorter durations and lower strike prices to generate higher premiums, while lower volatility may favor longer durations and higher strike prices. 2. Tesla stock price and implied volatility. The option selection depends on the current Tesla price and implied volatility, aiming to maximize premium generation while managing potential downside risk. 3. Time to expiration. TSLY may use a combination of short-term and long-term options to balance income generation and risk management. Question 10. How does TSLY's tax efficiency compare to traditional dividend-paying stocks? TSLY's income generation primarily comes from premiums received from selling options, which are generally taxed as short-term capital gains if held for less than a year, and long-term capital gains if held for more than a year. This can be more tax efficient than receiving dividends, which are typically taxed at ordinary income rates. How does TSLY ETF compare to other technology sector ETFs? Comparing TSLY directly to other technology sector ETFs isn't entirely accurate, because their approaches fundamentally differ. Here's a breakdown of the key points here. TSLY 1. Actively managed, employs option strategies on Tesla, TSLA, to generate income, not passively track a technology sector index. 2. Focuses on income generation, aims to generate consistent income regardless of the Tesla stock price direction through covered calls and cash-secured puts. 3. Limited capital appreciation potential, may experience limited capital appreciation compared to pure technology sector ETFs, if the options are exercised against the fund. 4. Higher volatility than broad market ETFs, can experience higher volatility than broad market ETFs, like the SP 500, but potentially lower volatility than holding Tesla directly. Technology sector ETFs 1. Passively managed, track a technology sector index, providing broad exposure to various technology companies. 2. Focuses on capital appreciation, aims to capture the overall growth of the technology sector, offering the potential for significant capital appreciation alongside inherent market volatility. 3. Direct exposure to underlying stocks, reflect the performance of the underlying technology companies in the index, potentially experiencing significant gains or losses depending on individual company performance. 4. Generally lower expense ratios, often have lower expense ratios compared to actively managed funds like TSLY. Choosing between TSLY and technology sector ETFs depends on your investment goals and risk tolerance. 1. Income generation. If your primary focus is generating consistent income, TSLY could be an option. 2. Capital appreciation. If you primarily seek capital appreciation from the technology sector, a broad technology sector ETF might be more suitable. 3. Risk tolerance. Consider your risk tolerance. TSLY may offer some risk mitigation compared to holding Tesla directly, but it still carries inherent risks. Technology sector ETFs are generally higher risk, but also offer higher potential rewards. Question 11. What are the potential consequences of a significant decline in Tesla stock price for TSLY? TSLY. A significant decline in Tesla stock price could lead to several potential consequences for TSLY. 1. Forced assignment of sold call options. If the stock price falls below the strike price of sold call options, the option holders might choose to exercise their right to purchase shares from the fund, forcing TSLY to sell its shares at a loss. 2. Losses on cash-secured puts. If the stock price falls below the strike price of sold cash-secured puts, the fund will be obligated to buy shares at a higher price than the current market value, potentially leading to losses. 3. Reduced premium generation. Lower implied volatility associated with a declining stock price could lead to lower premiums received from selling options, impacting the fund's income generation capabilities. Question 12. How does TSLY hedge against potential market disruptions or black swan events? TSLY. While TSLY's option strategies aim to manage risk, they cannot completely eliminate it, especially in unforeseen circumstances. The fund may utilize various techniques to manage risk, such as 1. Diversification within option strategies, using a combination of different option types, e.g., covered calls, cash-secured puts, protective puts, can help mitigate risk compared to relying solely on one strategy. 2. Hedging with other instruments. The fund manager might utilize additional financial instruments like futures contracts to further hedge against specific risks. Question 13. How does TSLY ETF incorporate factor-based investing strategies, such as momentum or quality, into its portfolio construction process? The TSLY ETF does not directly incorporate factor-based investing strategies like momentum or quality into its portfolio construction process. Here's why. 1. TSLY's primary focus is income generation. It primarily utilizes covered calls and cash-secured puts on Tesla, TSLA, shares to generate income, not actively seek exposure to specific factors like momentum or quality. 2. Factor-based investing strategies aim to capture specific characteristics of companies within a portfolio. Momentum might focus on stocks experiencing recent price increases, while quality might prioritize companies with strong financials and profitability. TSLY doesn't actively select individual equities within its portfolio. It relies on the underlying holdings of Tesla and the income generated through option strategies. However, indirectly, some elements of TSLY's strategy might marginally align with certain factors. 1. Covered calls can potentially capture some elements of a momentum strategy. By selling call options on Tesla, TSLY might benefit if the stock price rises due to positive momentum, as the options expire worthless, and the fund keeps the premium received. 2. Cash-secured puts can potentially align with a quality strategy. By selling puts on Tesla and holding cash as collateral, TSLY might be indirectly favoring companies perceived to be of high quality, like Tesla, by being willing to potentially acquire additional shares at a specific price. It's crucial to distinguish these subtle, indirect influences from the core intention of TSLY's strategy. Its primary focus remains on income generation through option strategies, not actively pursuing specific factor-based exposures. Therefore, if you're interested in explicitly incorporating factor-based investing like momentum or quality into your portfolio, exploring other investment options designed specifically for those strategies might be more suitable. These can include 1. Factor-based ETFs. These ETFs are designed to track specific factors like momentum or quality by actively selecting companies exhibiting those characteristics within their portfolio. 2. Smart beta strategies. These strategies aim to achieve superior risk-adjusted returns by deviating slightly from traditional market capitalization weighting, potentially offering some factor-like exposure alongside diversification. Question 14. Is TSLY ETF suitable for a retirement portfolio? Determining whether TSLY is suitable for a retirement portfolio is a complex question with no definitive answer. It depends on several factors specific to your individual circumstances and risk tolerance. Here's a breakdown of the pros and cons to help you make an informed decision. Potential benefits of including TSLY in a retirement portfolio. 1. Income generation. TSLY aims to generate consistent income through option strategies, which can be attractive for retirees seeking additional income sources. 2. Reduced volatility. Compared to directly holding Tesla stock, TSLA, TSLY may offer lower volatility due to its option strategies, potentially offering a smoother ride in your retirement portfolio. 3. Diversification. If you already have significant exposure to traditional assets like stocks and bonds, TSLY can offer some diversification within a technology sector holding. Potential drawbacks of including TSLY in a retirement portfolio. 1. Higher risk. Compared to traditional retirement portfolio assets like bonds and broad market ETFs, TSLY carries higher inherent risks due to its active management, option strategies, and focus on a single company, Tesla. 2. Limited capital appreciation potential. TSLY's focus on income generation through options might limit its potential for significant capital appreciation, which could be crucial for long-term growth in a retirement portfolio. 3. Complexity. Understanding option strategies and their potential risks requires a higher level of financial literacy compared to traditional investments. Here are some additional factors to consider. 1. Your age and time horizon. Younger retirees with a longer time horizon may be more comfortable with the higher risk associated with TSLY, whereas those nearing retirement might prioritize stability and lower risk. 2. Your overall portfolio allocation. If your portfolio is already heavily weighted in technology stocks, adding TSLY might increase your overall risk exposure. 3. Your personal risk tolerance. Some investors may be comfortable with the additional risk of TSLY for the potential benefits, while others may prefer a more conservative approach. Alright, to wrap things up, we've covered a lot of ground on the TSLY ETF. We saw how it utilizes option strategies on Tesla, TSLA, to generate income, offering potential benefits like consistent income, reduced volatility, and diversification within the technology sector. However, it's crucial to remember that TSLY also comes with inherent risks like limited capital appreciation potential, higher risk compared to traditional investments, and complexity due to its option strategies. So, the decision to invest in TSLY ultimately depends on your individual circumstances and risk tolerance. Carefully consider your investment goals, time horizon, and overall portfolio allocation before making any decisions. If you're unsure, consulting with a qualified financial advisor is always recommended. That's all for today on TSLY. As always, if you have any questions or comments, leave them down below, and we'll be happy to chat further. Don't forget to like this video and subscribe to the channel for more in-depth ETF analysis. Until next time, happy investing.